I have lived long enough to know that the most dangerous trades in the world are usually the ones that feel sensible right before they break. They do not look like panic when they begin. They look like consensus. They look like smart money agreeing with itself. They look like a dozen different explanations that all point in the same direction until people stop asking the only question that matters, which is what happens if the thing everyone is leaning on suddenly starts moving the other way. That is where I think we are with the dollar. A lot of people still treat the dollar as a side story. They treat it as a foreign exchange chart, a trader's toy, a technical line on a screen that belongs in some corner of the financial world far away from ordinary portfolios. I do not see it that way. When I look at the market right now, I do not begin with the S&P 500. I do not begin with a stock story. I do not even begin with earnings. I begin with a crowded trade sitting underneath all of it. I begin with the belief that the dollar was supposed to weaken, that the Federal Reserve was supposed to cut, that risk assets were supposed to benefit, that the euro had room to stabilize, that oil would not become the thing that rearranged the chessboard, and that you could borrow from a weak dollar world to finance strength somewhere else. That trade became very comfortable. Comfort is expensive in markets. Once enough people are on the same side, the trade stops being about who is right in theory and starts being about who can get out when price moves against them. That is why I pay so much attention to crowding. I have spent my life watching what happens when investors confuse a popular idea with a durable one. The biggest money is not lost when people do something foolish that everybody recognizes as foolish. The biggest money is lost when intelligent people repeat the same elegant argument at the same time and then discover the exit door is smaller than they imagined. Right now, the elegant argument has been that the dollar had nowhere to go but down. Retail investors lean that way. Institutional investors lean that way. Hedge funds lean that way. The large commercial crowd lean that way. Speculators lean that way. People took that weak dollar assumption and used it to justify a whole stack of other positions. They used it to get comfortable owning more equities. They used it to justify risk. They used it to finance other trades. They used it as a background condition that was supposed to make the rest of the portfolio work. That is why I do not think this is a little currency story. I think this is the spine of the whole market story. If the dollar rises hard from here, it does not stay in the currency market. It runs through everything. The part many people miss is that a short squeeze in the dollar is not just a line moving on a chart. It is a forced unwind. If you are short dollars, eventually you have to buy them back. That sounds harmless when you say it slowly. It is not harmless when millions of people are doing it at once because the dollars do not come out of thin air. People have to raise cash. They have to sell what they bought with that trade. They have to sell liquid things first. They have to cut what they can cut. They have to stop thinking like optimists and start acting like survivors. And when enough people make that turn together, price does not move in a neat, gentlemanly fashion. It lurches, it gaps, it becomes indiscriminate. I have seen enough forced selling in my life to know that markets do not politely unwind crowded positions. They punish them. If you pull up the dollar index and study the way it has behaved against its support and resistance zones, the danger becomes obvious. Every time the dollar dropped into support, buyers showed up. Every time it ran into resistance, people leaned on it and shorted it again. That pattern trained investors. It taught them that selling the dollar near those upper zones was the right habit. That is how markets educate people into the very behavior that later hurts them. A repeated pattern creates confidence. Confidence creates size. Size creates fragility. Then one day the pattern changes. Now the risk is that the dollar is not being rejected the way it used to be. The risk is that it is starting to break through. And if that breakout sticks, the people who learn to casually lean against the dollar are no longer harvesting an easy habit. They are trapped. The source material put it in the language of charts with the dollar index moving toward 102, then possibly 104. And beyond that, an even more violent move if the breakout truly takes hold. I do not rely on exact price markers as though they are sacred scripture, but I take the message seriously. The structure matters. The market has spent a long time behaving as though dollar weakness was the natural state of the world. If that assumption fails, the move does not stop at inconvenience. It becomes a repricing. One of the most important things in the entire piece was the simple overlay between the dollar and the stock market. People make investing harder than it needs to be because they are always hunting for a complicated explanation when a plain one is staring them in the face. As the dollar moved lower, the stock market rallied. When the dollar pushed higher, the broad market stumbled. That is not a complete description of every day in the market, but it is more than enough to warn you what kind of environment you are in. If the dollar rises because a massive short dollar position is being unwound. Risk assets are not getting a gentle breeze in the face. They are taking a punch. The market has been supported by the same backdrop that now threatens it. That is why I say the risk is structural. The market does not merely dislike a stronger dollar here. The market is partly built on the assumption that dollar weakness would continue. Once that assumption changes, the whole collection of trades built on top of it begins to wobble. I pay even closer attention when positioning data starts to confirm that institutional money is changing its mind. When institutions move from record underweight dollar positions toward neutral, that alone tells you something. When speculative traders cut their bets against the dollar in a meaningful way, that tells you something else. When large asset managers are cutting equity futures exposure at the same time, I do not shrug that off as noise. I have seen too many periods where the first real clue was not in a dramatic headline. It was in positioning. It was in who quietly changed posture before the public narrative caught up. The transcript talked about major institutions turning tactically bullish on the dollar for the first time in about a year, while other large investors were sending the strongest institutional flows in nearly 2 years. That matters. It matters because institutions are not changing their minds in a vacuum. They are responding to something. They are responding to risk. They are responding to the realization that the old trade is more fragile than it looked. They are responding to the possibility that what felt like a comfortable macro backdrop has begun to reverse. When I see that sort of turn, I ask a different question from the one most people ask. Most people ask whether the market can still bounce. I ask what the people with the largest exposure are now most afraid of, because fear tells you more than confidence at turning points. Confidence is cheap. Everybody has confidence in a rising market. Fear is expensive. Fear forces liquidation. Fear reveals what was crowded. Fear shows you which trade mattered most. In this case, the fear begins with energy. This is where the story becomes more interesting and more dangerous. If you only looked at the dollar in isolation, you might think the move is technical. It is not. There is a macro engine under it. Oil is a big part of that engine. As energy prices rise, the burden does not fall evenly around the world. Europe has a weakness that becomes painfully obvious whenever oil jumps. It depends heavily on energy imports. That means when oil surges, trade balances deteriorate, margins get squeezed, growth weakens, and the currency becomes vulnerable. That is not an academic relationship. It is an economic one. A region that imports what it desperately needs gets punished when that input becomes more expensive. And because the euro carries the biggest weight inside the dollar index, weakness in the euro is not some side effect. It is a direct lift to the dollar. That is why this story is not merely about what America does. It is about what happens to Europe when energy prices stay high into an already weak economy. The source document made a point that I thought was absolutely central. The euro area was already showing weakness. Purchasing manager surveys were soft. Growth was shaky. The economy was not entering this period from a position of strength. That matters. Weak systems do not handle new shocks. Well, a healthy economy can absorb some pain. A weak economy can be tipped by it. When the cost of energy rises into an already fragile European backdrop, the odds increase that the euro keeps weakening. And if the euro weakens meaningfully, the dollar can rise even if the United States is not doing anything heroic. Sometimes a currency rises not because its home economy is magnificent, but because the alternative is under greater pressure. That is another lesson markets teach over and over. Strength is often relative. Investors do not need to adore the dollar for the dollar to surge. They merely need to fear the other side more. That is what an energy shock can do. Now add monetary policy to the picture. For a while, the market narrative had been simple. The Federal Reserve would cut rates that would pressure the dollar. The European Central Bank might look firmer. That would support the euro. All of this fit neatly into the weak dollar consensus. Then reality began to interfere. Fed officials started signaling that rate cuts were not something investors should casually count on. Not immediately, not automatically, not in the way the market wanted. That matters. Because policy expectations are not decoration in a currency trade. They are fuel. If investors have been shorting the dollar partly because they believed the Fed would cut, and then the Fed starts telling them not to be so sure, the foundation of the trade changes. The transcript argued that the market had priced in additional cuts that may no longer come. I think that is exactly the sort of shift that turns a lazy consensus into a dangerous one. People can survive being wrong about a forecast if the position is small. They cannot survive it gracefully when the whole position was built on that forecast. The other twist is on the European side. The market had also entertained the possibility that the ECB would stay relatively hawkish. That too helped support the euro side of the trade. But if Europe is taking an energy hit and the growth outlook is deteriorating, the ECB may not be able to deliver what the market hopes for. And if the ECB disappoints those hawkish expectations, while the Fed refuses to validate easy-cut fantasies, the euro can fall hard. At that point, the currency story turns from a debate into a squeeze. That is the kind of sequence I try to respect. I never like situations where two assumptions can fail at the same time. Here the assumptions were that the Fed would ease enough to weaken the dollar and that Europe could hold together well enough to keep the euro from breaking down. If both of those assumptions wobble together, the short dollar trade becomes much more fragile much more quickly. The energy angle matters for another reason. People often misunderstand how inflation behaves during these episodes. They imagine that if oil rises, you get a clean, sustained inflationary boom. That is not necessarily how it works. You can get a burst of price pressure, you can get a visible lift in energy-related inflation. But if wages and demand do not keep pace, higher energy becomes more like a tax than a growth engine. Consumers feel poorer, businesses feel pressure, the economy slows even as some prices rise. That is a rotten mix. The source material emphasized the relationship between gasoline prices and CPI and made the argument that these energy spikes often create temporary inflation pressure that later rolls over as demand weakens. I think that point is important because it explains why an energy shock can be recessionary rather than prosperity-producing. It can squeeze the consumer damage sentiment and weaken activity. You do not need a long lecture to understand that. If people spend more on fuel while their hours and wage growth do not keep up, they cut back elsewhere. That is how weakness spreads. And if Europe is the weakest point in the system right now, then the stress there can become the stress that pushes the euro lower, the dollar higher, and global risk assets into a much uglier adjustment. This is where I come back to incentives. Markets love to believe that central banks can painlessly solve everything. They cannot. A central bank looking at an energy shock and sticky inflation optics may hesitate to cut aggressively. A central bank looking at weak growth and expensive energy may also hesitate to hike the way traders hoped. That leaves investors with the least comfortable outcome of all. Policy disappointment, not because the central banks are reckless, but because reality is messy, and messy reality is poison to a clean consensus trade. The transcript also brought in strategic petroleum reserve releases and a temporary exchange mechanism. That part may seem like a footnote to some people. I do not think it is a footnote. It tells you two things at once. First, policymakers are worried enough about energy prices to act. Second, even that action may not solve the near-term pressure. A slow release over months is not the same thing as instant relief. And if oil producers are willing to borrow crude now and return it later with a premium, that says something about expectations. It suggests they think the economics of the deal can work for them later. That can imply lower prices further out, but it does not automatically rescue the present moment. Near-term, elevated prices can still do the damage. Long-term prices may eventually roll over. Those two things can both be true. That is another habit I try to cultivate. I do not force the short term and the long term to tell the same story. Markets often live in the tension between them. The near-term consequence here is that elevated energy keeps the pressure on Europe and keeps the risk alive that the euro weakens further before any future relief arrives. The transcript also mentioned production constraints and barrels being shut in, with the implication that the supply side is not as flexible as people might like to imagine. That raises the odds that the near-term oil pressure is real, not imagined. And if that is real, the rest of the chain becomes easier to understand. Higher energy hurts Europe. A weaker Europe hurts the euro. A weaker euro strengthens the dollar. A stronger dollar stresses risk assets. Crowded short, dollar positions unwind. Selling pressure spreads. That is the logic chain. I care a great deal about logic chains. Good investing is not about memorizing isolated facts. It is about understanding how one condition changes another. When the chain is clear, you do not need 10,000 indicators. You need discipline. The part that struck me most in the original material was the warning that asset managers had already begun dumping equity exposure in size. That is the sort of detail people skip over because it sounds technical. It is not technical. It is behavioral. It means the people running serious money were not simply debating strategy. They were acting. There is a big difference. I have known many investors who could explain every macro risk in beautiful language and still fail to reduce exposure because action is harder than explanation. When asset managers begin cutting longs at unusual levels, I pay attention. When ETF shorting rises sharply because investors feel trapped in long exposure and need a hedge, I pay attention. Those are not healthy market signals. Those are pressure signals. They tell you that people may still be publicly hopeful while privately defensive. That combination shows up before trouble becomes obvious. The original piece framed the danger in stark language, talking about recession or even financial crisis. I try to be careful with dramatic labels because people throw them around too easily. But I also know that dismissing stress early simply because the words sound dramatic is another common mistake. What matters is not whether a commentator uses intense language. What matters is whether the structure underneath the warning makes sense. Here, a lot of it does. Crowded currency positioning, energy stress, European vulnerability, a shifting rate cut narrative in the United States, potential ECB disappointment, institutional de-risking, a clear relationship between a stronger dollar and pressure on stocks. That is not a random collection of worries. That is a coordinated risk map. When enough pieces point in the same direction, you do not need certainty to respect the possibility of a hard move. You only need humility. Humility is underrated. People think the intelligent investor is the one who predicts perfectly. I do not. I think the intelligent investor is the one who notices when the odds have become asymmetrical and responds before being forced to. If I believed the market was priced for tranquility while the biggest crowded trade underneath it was beginning to unwind, I would not respond by doubling down on comfort. I would respond by reducing the need to be exactly right. That is what hedging really is. It is not an admission of ignorance. It is an admission that the world does not owe you a smooth path. The source transcript eventually got practical. And I think that is where many people need the most help. When fear rises, they either freeze or become theatrical. They want one grand move. Life is usually improved by fewer grand moves. If you are a trader, the setup in the material was straightforward. A stronger dollar expression can make sense if the breakout is real. If the dollar index moves toward the next zones around 102 and 104, that confirms the pressure. If it gets far beyond that, the stress on other assets could intensify. That is the trader's lens. But most people are not pure traders. Most people have portfolios, retirement savings, and an emotional threshold. For them, the more useful lesson is not that they need to transform themselves into macro geniuses. It is that they should respect crowding and protect themselves before protection becomes expensive. The material suggested cutting some market exposure, perhaps 10, 20, or 30% depending on the investor and the level of risk, and using dollar strength as a hedge rather than sitting naked inside a fully risk. On posture, I think the spirit of that advice is sound. Not because every person should use the exact same percentage, that would be silly, but because the principle is right when a market has rallied with the help of a weak dollar backdrop and that backdrop begins to reverse. Trimming exposure is not cowardice. It is common sense. One of the worst habits in investing is the belief that prudence must look dramatic to count. It does not. You do not need to sell everything to become safer. Sometimes the smartest move is simply to stop being overexposed to one narrative. That is especially true when the narrative has become crowded. A lot of investors secretly believe diversification means owning many tickers. That is not diversification if all those tickers depend on the same macro condition. If a large share of your portfolio thrives only as long as the dollar remains soft, liquidity remains easy, and investors remain carefree, then you do not own diversification. You own one trade in many costumes. This is why I always try to reduce investing to the simplest useful truth. What are you really betting on right now? Many people think they are betting on American innovation, on quality businesses, on long-term optimism, on growth, on resilient consumers. Maybe they are, but underneath that, they may also be betting on a weak dollar, falling energy pressure, dovish central banks, and a stable euro. If they have not admitted that to themselves, they cannot manage the risk. Once you see the hidden bet, the portfolio becomes easier to judge. Honestly, that is what this document did. Well, it pulled the hidden bet into the open. It said the market has been leaning on a massive short dollar trade. It said energy is threatening the euro side of the equation. It said the Fed may not provide the cuts people assumed. It said institutions are already stepping back. And it said if the dollar really breaks out, the unwind could be violent. That is a coherent warning. A coherent warning deserves more respect than a comforting slogan. I have no interest in pretending that every stress becomes catastrophe. Most do not. But the time to think about catastrophe is before you need to. That is why I spend far more time trying to avoid situations that can seriously hurt me than trying to squeeze the last drop of upside from every market phase. The compounding of capital depends less on brilliance than on survival. If you survive the hard stretches with your capital and judgment intact, you can take advantage of future opportunities. If you let a crowded trade pull you into a forced exit, the future opportunities are no comfort. There was another subtle insight in the original material that I liked, the possibility that after enough downside and enough shorting, a powerful rebound could emerge later because the short positions themselves would need to be covered. That is true. Violent declines often create the fuel for later rallies, but later is not now. That distinction matters. Investors lose a great deal of money by being correct too early in their minds. They look 3 moves ahead while ignoring the one directly in front of them. If the unwind is still underway, the fact that a rally might come after enough damage does not protect you during the damage. First you survive the squeeze, then you look for the rebound, not the other way around. That sequence is a discipline problem more than an intelligence problem. People want to skip the unpleasant middle. The market rarely lets them. I also think there is a philosophical lesson buried inside all of this. The modern investor has become too accustomed to thinking that every problem has a policy backstop and every drawdown has a quick narrative rescue. That habit creates fragility because it encourages people to ignore how dependent their confidence has become on certain macro assumptions. The moment those assumptions wobble, they do not just lose money, they lose their framework. That is when mistakes multiply. A person without a framework is easily bullied by volatility. That is why I try to carry a few durable ideas with me in every market. Crowded trades are dangerous. Currency moves are not separate from equity outcomes. Energy shocks expose weak economies first. Central banks do not owe the market the outcome it has priced in. Institutional repositioning matters. And when you discover that your portfolio was quietly depending on a condition that is now reversing, you should not negotiate with reality. You should adapt. If I were looking at this setup from my own chair, I would not obsess over day-to-day noise. I would ask whether the central premise of the bullish risk trade is getting stronger or weaker. To me, it looks weaker. I would ask whether the dollar has room to rise because positioning was too one-sided. To me, it does. I would ask whether Europe is vulnerable enough that energy could become the mechanism of currency pressure. To me, it is. I would ask whether investors counting on easy Fed cuts may be disappointed. That is very possible. I would ask whether institutions are already behaving more defensively than the headlines suggest. The evidence says yes. Once those answers line up, prudence is not complicated. You reduce your dependence on a benign outcome. You stop pretending that comfort is safety. You remember that the market can stay enthusiastic for a while and still be one turn away from an ugly repricing. That is the part people never quite believe until they live through it. They think a dangerous market must look dangerous before it becomes dangerous. Usually it does not. Usually it looks expensive, crowded, and strangely confident. Usually it looks like a place where people are still explaining why the old trade should keep working. Usually it looks like this. The old joke on Wall Street is that markets climb a wall of worry. Sometimes that is true, but markets also build a floor over hidden cracks, and when enough weight stands on the wrong place at once, the break is sudden. I do not know the precise day this dollar story resolves itself. I do not need to know. I only need to know that the ingredients for a forced unwind are there. A giant short dollar position. A breakout risk in the dollar itself. A stock market that has benefited from the opposite condition, institutional de-risking. A vulnerable euro. An energy shock pressing on Europe. A Federal Reserve that may stay firmer than traders wanted. An ECB that may not be able to satisfy the hawkish fantasy. A portfolio landscape full of people who do not yet realize how much they were all leaning on the same assumption. That is enough. In investing, enough is enough. You do not wait for perfect clarity when the penalty for waiting may be a much more expensive decision later. You do not confuse optimism with discipline. You do not let a crowded trade decide your temperament. You decide it yourself. That is what I would urge any serious investor to do here. Take inventory, find the hidden weak dollar assumptions in your holdings, reduce the positions that most depend on a calm macro environment. Accept that preserving flexibility is a strength, not a failure. And if you choose to hedge, Do it while the market still lets you think, because once a short squeeze turns into a true unwind, thought gets replaced by reaction. And reaction is where people pay the highest price. I have made a great many decisions in my life by asking where the incentives point and where the crowd is most exposed. Right now, the incentives tell me that high energy can keep pressuring Europe. The crowd tells me that too many people were positioned for the opposite currency outcome. The market tells me that dollar strength and equity weakness have been dancing together for some time. And policy tells me that the easy rescue many investors assume may not arrive on schedule. That combination deserves respect, not panic respect. Respect leads you to trim when others are still relaxed. Respect leads you to hedge when others are still rationalizing. Respect leads you to value liquidity before the scramble. And respect is usually far more profitable than bravado. The world's biggest risks are often hiding in what investors decided was obvious. The weak dollar trade became obvious. That is exactly why I am paying attention. Now, when the obvious trade stops working, it can stop working in a way that drags everything else with it. I do not know whether the unwind becomes mild, severe, or historic. I do know this: when a market is built on the same assumption across retail money, hedge funds, institutional managers, and the commercial crowd, and when the macro facts supporting that assumption begin to reverse, I would rather be early in protecting capital than late in mourning it. That is not fear. That is discipline. And discipline is usually what separates the investor who can keep compounding from the one who spends years trying to recover from a drawdown that should have been respected the first time.